everyone, welcome to second part of week 10 taxation of trust. This is the second installment of week 10. So in the first video we talked about taxation of partnership, whereas in here we're going to taxation of trust. So now, before we keep going, let's talk what is trust is. Trust is the equitable obligation binding a person or trustee to deal with partner with the property over which he has control. Yeah, you read that one. I'm not going to read for you because, well, you can read that one. Alright, so the main difference here. So I want to see what happened outside there. Why would people make trust in the first place? Unlike, what we call it, unlike something we call the partnership in the previous video, the partnership, if you want to be partner in a partnership, you need to control it. So technically, you can't put your son, you cannot put your daughter as your partner because, well, you know, they're not going to, it's going to be hard to justify there's a partner, especially if they're still 18 years old, 19 years old kid. They cannot be considered a partner. But in trust, you can do that one. You can put your daughter, or 18 years old daughter, or 18 years old your son as what we call the trustee. So in that way, let's see if the trust make $100,000, you can give them $18,000 to 100. So if you got 3 kids, you give them 18,000 each, then it's around 54. The rest you kept it. In that way, your kid will never have to pay tax because remember, $18,000 it's you know, that's the free tax region. So in that way, then you don't have to pay tax. That's not possible to do that one in partnership because in a partnership, the amount that the money that you make is going to be depends on like whether the partner is actually working or not. So if the partner is not working and you still distribute income to him or her, they're going to be penalized with a 45% tax rate. And the trust, no. You can do whatever you want. So if you have 5 kids and everything, so this is the way to mitigate the tax. I mean, not the reason why but that's the most reason why would people have trust in the first place, because they got a lot of income, they don't want to pay a lot of tax, and they have a lot of relatives or little kids that they can share the money with, so rather than just paying the tax by themselves. Which is, you know, in Australia, when you start making like 90,000 above, your tax rate is going to be like pretty high. On the other hand, if you somehow you can spread those money, then that will be better off. So this is the main reason here. Alright, so let's just go through here. Alright, so this is the partner, like the example of the trust here. So settler here is the person who create the trust, anything that create the trust. Also the person who bring the properties is basically the one who taking care of the whole thing here. So trust deed is document that can document that set off right in documents by trustee. The trustee here can be a son, can be a wife, can be anyone. Trust property there, the money, real estate, share, and business. Trustee may be natural person or even company. So beneficiary, people who receive from trust, yeah. So we got trustee is the one who taking care of the whole thing, and beneficiary is going to receive the benefit. Trust is not a separate taxable entity, so again, it's almost like the partnership, so you don't have to pay tax. I mean, like, you know, the partnership, you don't have to pay tax. The one who paying the tax is partner, whereas in trust, the trust doesn't pay tax. The one who paying tax is trustee and beneficiary. The trustee must lodge the trust income tax return just to record how much income they make, but they're not going to pay tax for that one. A trust cannot distribute trust losses. Yeah, that's the thing. Unlike in a partnership, the loss can be distributed. So, you know, whenever they make loss, the partner can claim as the deduction. That's good for them. So the payment of the tax depends whether the beneficiary is presently entitled. We're going to talk a little bit what is presently entitled. Taxation of trust. So this is the main difference again. So those two are very similar. Trust and partnership are very similar in a way because none of them have to pay separate tax rate. In a partnership, the one who pay tax is partner, whereas in the trust, the one who paying tax is trustee and beneficiary. Okay. So trustee and role. So trustee is the one who taking care of the whole thing, and also the direct the benefit to the beneficiary. So if, for example, if I want to build this thing, I'll be the trustee and beneficiary could be my daughter, my son, my wife, my mom, my dad. No, if they're retired, for example. The trustee hold the legal title to the property, but the property is not beneficially his, so you know it could be done that one. A trustee hold the property as the legal representative of the beneficiary, respond on equitable obligation. So that's the thing. So the trustee may be a beneficiary as well, but cannot be the only beneficiary. So again, I could be trustee, also can be beneficiary. So now let's talk about here. This is the interesting. As I mentioned before, the reason why people build the trust in the first place is normally the wealthy family who are making a lot of money from investment, but the parent doesn't want to pay too much tax because they wonder why I'm paying that much tax. So, and normally this family, they have a lot of kids, like 3 or 4 kids, and they're still pretty young, and they're not really working. They have the trust fund. All right, so that's like what is the trust fund here. So beneficiary will be taxed if principally entitled to share income of trust entity, or they have legal to demand right. So we have to give the money. But in the real life, normally the parent will ask the money back, or just put it somewhere. Yeah, so they have to be able to receive those money. Now, in the practical world, a lot of those kids, they have no idea they're being directed to trust in the first place. They just put the name under, the family, the dad open the bank account under their name, put whatever money they have in that one. So Brand 2010 means the income defined under trusted, applying accounting principle. Beneficiary presently entitled, make surely aware that the income is belong to his or her if he's principally entitled. If he's not principally entitled, it's going to be complicated. All right, so when I say principally entitled here, the beneficiary aware they receive this money, and they're also aware they're going to they could enjoy this money. The fact they want to give this money back to their parent is up to them. Nevertheless, they have to be aware, I have this money, I can spend it if I want to, but if I want to return to my parent, that's fine as well. So this is example here. Trust is the principal entitled 40% income of family trust for 1920 of $20 of $200. So being $80 is the trust net profit. However, trust income 1920 is 100, then therefore be assessed for 40%, 1920 income for $140. So this example, the income of trust estate and net accessible income. Again, so this is I'm not worried so much about this. This is the different. The reason I want to mention here, let's see what we can do. All right, let's see benefit of the trust. That's the thing that we want to. So the beneficiary on his or her share of the net trust income, assuming he's principally entitled, yeah, they're aware and he could actually spend those money. Non-essential income is actually distributed. Principally entitled will make the beneficiary share of the income. So what they're trying to mention here, a lot of family, they're building the trust, they put the name of the son, the daughter, without the knowing of, their knowing. In that one, that's not principally entitled, and technically they are illegal. All right, and some situation, so this thing here, the trustee were beneficiary are principally entitled but under a legal disability. What is this? What is legal disability, Michael? So legal disability is could be a couple of them. If they are under 18 years old, they're going to call minor because that's legal disabled. And also if they are handicapable, which is I'm going to explain in a second. So no beneficiary and principally entitled to income the trust. Non-resident beneficiary are principally entitled and therefore difficult in collecting the tax. So we'll talk about this thing very soon. So trust net income. Let us go to example. The trust, there are $15,000 rental income, and that represents $5,000. So we know it's the net income is going to be $10,000. So we got trust in here. So must include income from all source in the assessable income of resident trust. A trust is deemed to be resident if trustee is a resident or central management trust in Australia. So this is the rule as well. The trustee has to be resident of Australia, but if you're not in the week 1, it's pretty easy to be resident of Australia for tax purpose. It's different thing with for immigration purpose and tax purpose. They're completely different things. So everyone can be, resident for tax purpose. So in here, let's talk a little bit here. So making beneficiary principally entitled. So what does that mean? I mentioned it a bit. Principally entitled, they need to be aware. All right, need to be aware and also be able to spend it. So if you just give to your kid, but the kid is not aware and they have no intention of spending money, or they don't, you mentioned like you give the money to the kid, but the kid, without their knowing, that's not principal entitled. If not principal entitled, there's going to be penalty there. Okay, in the actual world, in the real life, a lot of those kids, they just sign because they mention, I live with my parents, so we just accept whatever parents tell them. So now let's see here. If beneficiaries are entitled 50%, they will be assessed 50% of net income. So let's see what happened here. So principal entitled here, beneficiary is in a position of demand immediate payment income of trustee. So if they mention going to be 18,200, so they'll be able to receive the money and they have right to spend it. So the parent cannot tell them, you cannot spend money, that's my money. In that way, they are not principal entitled. Alright, so be careful with that one. Just because so this is not the ultimate one. Alright, so just because you can distribute the money to your kid, but if your kid do not give them consent to you to take the money back, or another way of saying like you give them 18,200 but the kid refused to give money to you, they're allowed to do it. But if they have no right to do it, they're not principal entitled, and it's going to be complicated for you. So benefit will be assessed if they're principal entitled on net income. They're going to use the normal tax rate. Alright, so if you give them 18,200, they're not paying any of this, and that's the reason why people love the idea of trust. And principal entitled plus legal disability here. What is this, Michael? Legal disability here, it's something we call the minor. Minor is under 18 years old. If you're under 18 years old, you can give only 400. You give them more than that one, the tax rate is pretty high. Innocent or bankrupt, it's going to be legal disability. That's the problem here. So trustee will be assigned on behalf of beneficiary at rates applicable to beneficiary, MTR and MTL. So if minor, it's dangerous because under 18, you only give them 400. More than 400, the tax rate is maximum. But other than that, that's fine. So the last one here, so also for I mentioned before, someone who is sorry, that's a strong word, in sense basically mentally disabled, also be treated equally. Just because someone mentally disabled doesn't mean they have to pay more tax. They're paying the same tax. That's the whole point. So no beneficiary entitled for section 99. So basically here, for income trust estate, trustee personally assess any net residual income trust estate. So basically what happened if the beneficiary no beneficiary entitled, this is the implication. Now let's just talk about beneficiary entitled. Alright, so rest income is what is beneficiary entitled is legally available. So if I give to my kid, they have right to spend it. Let's say if they got 18,200 that year, if they want to buy a new car with that one, there's nothing can I do to stop them. I cannot tell them that's my money. I'm just using your name to reduce the tax. If I'm making any threat to my kid like that, it's not personally entitled. Therefore, the whole trust will just fall apart. Alright? Be careful with that one. Alright? So, yeah, just be careful. Yeah, that's the thing. So contingent interest, beneficiary will be presently entitled if beneficiary has only contingent interest. Condition, I'm not worried with this thing. Just remember the first part here. Yeah, that's a big one for me. If they're presently entitled, again, you can enjoy the free tax regime there. So that's good for you. So taxation of beneficiary when entitled but under legal disability. So let's see what happens. Again, if beneficiary is legally entitled, they have right to spend it, but their kid is his kid under 18 years old and bankrupt, mentally incapable, incarcerated, go to jail. So what consequences? If beneficiary under legal derived income from this source, you still treat it as exactly the same as it is. Alright, so it doesn't matter if you are in the jail, you are mentally incapable, you're not going to be penalized for this one. So if you receive the money from trust and you're one of them, yeah, you're one of them here, you are you are bankrupt, insane, mentally incapable, or incarcerated, you're not going to be penalized. You're still going to pay exactly as if you were not have under legal disability. The only thing changed here, if you are minor. All right, if you're minor, this is the ATO draw the line. If you give minor money, so like for example, I got my daughter, she's only 1 year old. If I put her as one of beneficiary, I can do that one. There's no law doing that one, but maximum I can give her is only 416. Well, that's technically not maximum, but I give them more than 416 with 68% on excess and 45% on cap. That will defeat the purpose. The purpose of doing this one is to reduce the tax. If we end up paying more than this one, you know, it's no point. Like, you know, it will defeat the purpose to reduce the tax. If you end up paying like 68% tax and 45% tax. So that's the thing. So the reason why doing this, it's basically to avoid and encourage the effort thing, split income to the children who are too young to have independent income. If you give to 1 year old kid or 5 years old kid, what they going to do with money? So basically, you just use them as a pawn to reduce your tax. And you know, an ATO frown upon that one. So that's why if anyone under 18 and you become a beneficiary, yes, you can give the money, no one will stop you there, but more than $400, yeah, you're going to trouble. Because why? Look at that, yeah, because it will defeat the purpose. You won't be able to enjoy any tax benefit, yeah, because before this thing, people keep doing that one. They put they have as many kids as they have as possibly just to reduce the tax, and that's not nice. For government, for people, yes, of course, that's good. Division 6AA does not apply the exception person here, neither the exception income. Okay, so minor in a full-time employment, so this could be that one. So sometime 15 years old can be working here. It happens in here. I don't know how, this doesn't sound right. I don't know. Suffer for incapability and eligible for child disability allowance, it could happen. And double orphan, doesn't have mom, doesn't have dad. They could have received the beneficiary for that one. Accepted accessible income as employment-based income derived by minor. I cannot even think what that must going to look like. But anyway, so this rate, it may not applicable if you can satisfy this condition. Who minor, who working full time. Yeah, some 16 years old, they decide not to go with high school. Some kids, they don't want to go to high school. They finish their high school and they go, instead of going to uni, they're just working full time. So they will be eligible to receive all of this. Don't have to get penalized. And that's it. And also double orphan, doesn't have mom and dad, will be fine as well. And suffer in, yeah, that's the thing. Also accepted accessible income here. Investment derived from deceased estate, investing accessible income. So you don't have to pay all of them here. If you don't have to pay this rate, if you one of this. So now talk about team present entitlement. We discussed a little bit what present entitlement is. It's on, and now we got the new term we call team present entitlement. What is this? It's only happened in the discretionary trust, where trustee has discretionally to pay or apply trust income for benefit of specific beneficiary, and only where the trustee exercises his discretion effectively on behalf of this one. So it's basically in here I can choose. So let's see in the discretionary trust I can do this thing. So let's see this year I make only like 3,000. So what I would do, I can just keep all the money to me and give not, which is I'm also beneficiary, and give none to none older than beneficiary. Because why? I make too less this year, so there's no point for me to split my income. It's too less. Okay, so that's the point here. In that case, that will deem beneficiary to be presently entitled to amount be applied, then benefit trust excess discretion. So basically, in a discretionary trust, I can change the amount that I would like to distribute to my trust beneficiary. That's basically what they say. Again, the reason we doing this one to reduce the tax, you know, because this has got some benefit into it, but the benefit only apply until a certain level. Like you cannot just what we call that take advantage from this one and abuse the system. And if you abuse the system, you will be end up to be paying top marginal rate. So yeah, So when no beneficiary is presently entitled, as I mentioned before, none of them consent. You basically, they say you give to your children who is 18 years old, but you tell them you can't spend this money. Whenever you got the money from trust, you need to give back to me. And we're spending money, then I'm going to sue you. In that way, that beneficiary is not presently entitled, and whatever income you're going to give to him or her is going to be 45%. And that's basically the penalty rate. Alright, they want to make sure what you do there is the right thing. That's the thing. So now this is the situation. The Smith family, Smart Trust family. So income is 2019-20. This is the total income we're going to make here. So total net interest income is 40 grand. So what we do here, we got Mary, John, and Robert. So the only thing that I'm worried here is John. That's why John is a kid. He's under 18, so he's a minor here. But we give him 10 grand. So let's see what we do here. So we got altogether 40 grand. Robert is 10,000, mentally incapable. As I discussed before, it's not going to be penalized with anything. Alright, we're still going to be exactly the same. So now let's see here. So Mary is the normal person, like the adult, the gross tax payable. So he got 10,000. She's also working another job. Total of her income is 40 grand minus the tax rate and everything. So basically, and marginal levy. So this is just normal tax. The week 1, check the week 1 and week 2. The total tax payable here is going to be 4,947. Okay, normal tax rate. All right, that is cheap. Okay, so what is present entitled? You give money to Mary. Mary can spend it if she wants to, but she can give back to you if she wants to. It's not up to you though. It's up to her. So now John, he's presently entitled. He gives down. Yes, daddy. I like you to take my money. But the thing here, John is under legal disability. So what you do to them, when you give them 4,000, 10,000, and remember, anything above 400, the rate is going to be pretty high, and somehow you still neglectfully, you still give them 10,000. This is very bad accountant. Whoever gives this advice, this thing is just, I don't know, something wrong with this guy. But anyway, I'm not going to comment on that one. So taxable income is 10,000. Gross taxable income. Look at how much tax you have to pay. 4,500. You give him 10,000. The government take 4,500. And that's crazy. Because why? Well, the kid's still under 18. Look at how much tax. Imagine here, Mary. How much tax you have to pay here. Yeah? Only like 4,000, and she make another $30,000 though. And the tax that she's paying is the same what this kid won't paying. Because why? We penalize this one because he's a minor. He should not receiving this money. He has no idea how to spend this money. Who's going to spend this money? His dad, the one who make this trust. So that's why, you know, government see through this thing. We just penalize by this tax rate. Alright? So now, Robert presently entitled, as I mentioned before, just because Robert is mentally, have legally disability, it doesn't mean Robert will be penalized. Robert's still going to enjoy the benefit of not paying, you know, the free. Remember, if you got 18,200, so you're not paying tax, and Robert receiving 10,000, basically, Robert paying nothing. So look at, both of them are kid, John and Robert. One of them paying no tax, another one paying 4,500. Both of them receiving $10,000, but one of them paying nothing, one of them paying tax this much. Because what? In here, Robert is already not minor. So because of that one, Robert don't have to pay. Doesn't matter whether he's in jail, mentally incapable, and sort of another legal disability, except minor. Alright. So now, remember before, altogether we make 40 grand. Yeah, so make 40 grand. So the rest, 10 give Mary, 10 give to John, another one 10 give Robert, and the last one we reinvest. So what happens if we reinvest? You know, net income is so assessed to be trustee under the trustee. Let's say me, it's the dad, the one who making it. Right, the tax payable is depend on the commission or excess deduction under here. So the net trust income will be taxed as the maximum marginal tax 45%, including in here. Okay. And that's scary. Alright, so if you decide to invest that amount, might as well just give to mom. Alright, if you give to mom, the tax doesn't have to be that much. Decide to invest it that one, look at how much you have to pay tax, 45%. The idea is, yeah, because, well, alright, not going to go there, but that's okay. Okay, so that's the idea here. So now this is something we call frank dividend. So I'm not going to talk so much about this. This is information. So in this subject, I'm not talking a lot about the frank dividend. So it's just there, you can read it, but I'm not going to worry so much. Revocable trust. So this is something interesting. So when a settlor has the power to revoke or alter the trust to obtain the beneficial interest in the trust. Trustee is assessed on a share of them. So in here, the settlor, or basically normally the lawyer is the person who actually dealing with that one. Sometimes we give them the ability to control the whole thing here. They just to control, cancel, or even change the beneficiary and everything. Tax on a settlor taxable income, marginal tax rate, less tax applicable. Only settlor has to be net taxable here. So let's just go here. Alright, let's do here. Settlor has the power to revoke trust to acquire beneficial interest in here. Let's see the income altogether is 30 grand. So net interest income is 20. So that settlor taxable income is 50 grand. So under here, so how we can distinguish here? The 50 grand. So this is how much that we're going to, the trustee will be taxed as follow. So 7,090 minus the tax on settlor. So if you decide to give some of the money to settlor, you're going to receive a little bit of here. So tax assessed against trustee, not only 5,554. Again, it's there, but again, that's not my main interest in this subject. I just want to give the taste what is trust in here. So I'm not worried so much about that. It's there, but I'm not worried. Now this is the one important, because the reason why building trust, of course, we want to reduce the tax. Some parents who are very wealthy, they don't want to pay too much tax. But what happens if one of the parent, the one who set up the trust, pass away? And you know, the benefit will go to trust. So how about if the benefit that give the trust is the kid who's still very young, kid 14? Are they going to be penalized? That's what we're going to talk here. So income increases after the debt is deemed to be income, which is no beneficiary presently entitled. So let's see if one of the beneficiary pass away. Let's say the mom pass away under this one. So they are not presently entitled. So if they're not presently entitled, remember the idea is going to be taxed at 45%. This will be ceased case under administration. This estate is complete. Commissioner will allow up to 3 years after death of deceased debt to complete administration. So basically, they cancel the trust altogether or move the beneficiary to someone else. Non-resident beneficiary. Alright, sometimes you give the beneficiary to someone in overseas. So how we gonna pay tax for here? The trust is assessed under Section 98(3) on a share of the net trust income attributable to in Australia. Non-resident beneficiary liability tax reduced by the amount any paid by trust. So the one who's, if we decide to put beneficiary who is non-resident, someone who located in England, yeah, it could happen. The kids just study in England. They have no intention to go back to Australia. They have people to stay in Australia. They have people to stay in England, but they're still part of the trust account. In that way, he's not going to be resident. So the consequences will be, the one who's going to be taxed will be the trustee, the dad, the one who set it up, the whole thing. So that's, you know, the calculation in the end, like this one. So the benefit and risk of trust. Something we have the flexibility distribution of income and according to the need of the tax rate. It can be changed though. That's a beautiful thing of the trust. Unlike partnership, 50-50 and that's it. You can't just change it halfway. You have to be signing contract and everything. But in here, we change into whatever they want. Like, you know, for example, this year, John's still 17 years old. We give them only $400 because we know anything above $400 is going to be penalized by law. But next year, John is 18. We change the historical income, give them 18,200 because we know that one is free tax. Yeah, see, we can change just like that. And also, for example, during this year, mom doesn't work much, so we give them a little bit more money. So because she doesn't earn any money at all, so that's why, yeah, that's good. But this year, let's say next year, she decides to go back to work, she start earning money, we just reduce her income for as beneficial to be reduced, because why? We don't want to pay that much. Okay, so asset protection, because assets owned by trust rather than individual and not available to creditor. So basically creditor cannot come to the owner to individual, to us individual, because what? It's owned by trust. All right, so it's almost like got the separate entity, almost like the company. Likewise, that's a nice thing. Succession planning, so allow the asset owned by the family to pass down generation without triggering CGT. And remember, if in the family, if they move, some the parent pass away and the asset going to be moved to the other, they're going to be triggered another CGT event. The receiver of the benefit may have to pay tax. But if you have put in the trust, that one, never have to pay tax. Yeah, never have to pay CGT, and that's good. Remember, CGT is a lot though, even though you got 50% discount, but still no one want to get it on. So that's the nice thing of trust. Normally out of, yeah, so that's the thing. And disadvantage, complex and costly to run. During my time working as a tax accountant, the thing I hate the most is dealing with trust. Well, it's not because, yeah, I hate it because it's very complicated. There's a lot of things I need to check with, you know, well, that's the job. But anyway, it's very complicated to remember, right? Has to presently entitled, have to interview the kids, like who receive, are you happy to give the money back to your parent? Have to make sure he said yes. You said no, then it's not presently entitled, and that's the whole nother thing, because trustee will have to pay 45% if no beneficiary are presently entitled, and that will defeat the whole purpose. Because if one of the kids decide to rebel and they said, nah, I'm not giving away my consent to take this as a trust anymore, it will defeat the purpose of trust. So if some friction happen in a family trust, the kid fighting with his dad, then yeah, the trust will be fall down. It's going to be very hard to fix it. All right, so anyway, so that's the whole thing for today. So that's the end of week 10. Thank you for today, guys. Bye for now.